Hello.
Hi there. What's up?
I was studying the Negotiable Instrument Act of 1881 and I have a doubt regarding promissory note.
Okay.
So, in case of stamping a promissory note must be properly stamped in accordance with provisions of the Indian Stamp Act, and such stamp must be duly cancelled by maker's signature or initials on each stamp or otherwise. When they say must be duly cancelled by maker's signatures or initials on such stamps or otherwise, what does it mean?
Let me check on that for you. Here, canceled doesn't mean invalid. It means marked so it can't be reused. Under Section 12 of the Indian Stamp Act, the person signing the promissory note should sign or initial across each adhesive stamp. That way, it's clear the stamp was used for that specific instrument and can't be lifted off and reused again.
When they
Or
say
otherwise,
when they say duly cancelled, what do they mean?
duly canceled basically means properly marked as required by law, usually by signing or initialing across the stamp.
So it in actual it doesn't mean cancelling. It just mean about properly signing on the stamp.
Exactly. It's about properly marking the stamp, not canceling the whole note. The mark prevents reuse and shows the stamp was used for that note.
So when they use the stamp or otherwise, what does the otherwise word stands here?
Let me take a quick look. Here, otherwise just means by any other effective method. So, besides signing or initialing, you can mark the stamp in some other clear way that makes it obvious it was used, like drawing lines across it or writing the date across it. The key idea is the stamp can't be reused.
There are three parties, which is drawer, drawee, and payee. Could you explain me?
Checking? Yep. So, drawee, and payee apply mainly to a bill of exchange or check. The draw is the one who makes the instrument and orders the payment. The drawee is the party directed to pay. And the payee is the one who receives the money. For example, if A writes a check on their bank to pay B, A is the drawer, the bank is the drawee, and B is the payee.
So is it possible that the drawer is the payee itself?
One moment. Yeah, it is possible. The same person can be both draw and payee. For example, A draws a bill on B payable to A himself. That makes A both the drawer and the payee. And B is the drawee.
So the drawee is the person directed by the drawer to pay is called a drawee. He is the person on whom the bill is drawn. On acceptance of the bill, he is called the acceptor and is liable for the payment of the bill. His liability is primary and unconditional.
One moment. Yes, that's correct in the case of a bill of exchange. The drawee is the person on whom the bill is drawn, that is, the person directed to pay. Once he accepts the bill, he becomes the acceptor, and his liability is primary and unconditional, so the holder can demand payment directly from him.
Yeah, can you explain me about its essentials of the bills of exchange? Essential characteristics.
Let me check that real quick. Essential characteristics, it must be in writing. It must contain an unconditional order to pay. It must be signed by the drawer. There must be three parties, the drawer, drawee, and payee. It must be for money only. The sum payable must be certain. The payee must be certain. It can be payable on demand or at a fixed or determinable future time, and it must be properly stamped as per the Stamp Act.
So drawer, drawee, and pay must be certain. All of these three parties may not be necessarily be three different persons. One can play the role of two, but there must be two distinct persons in any case, as per section 31 of the RBI Act 1934. A bill of exchange cannot be made payable to bearer on demand. What do they mean when they say a bill of exchange cannot be made payable to bearer on demand?
Checking. It means you can't create a negotiable instrument that works like paper money. If a bill or note says pay bearer on demand, whoever holds it could use it like cash. Section 31 of the RBI Act reserves that kind of bearable on demand instrument basically to the RBI and government. So individuals or firms can't issue one. You can still have instruments payable to order or bearer at a future time, though.
So what's the meaning? Is it that bills of exchange cannot be a bearer?
Let me double check. Not exactly. A bill of exchange can be made payable to bearer, but it cannot be payable to bearer on demand. If it's bearer on demand, that's the combination that's not allowed.
So what's the difference between a payable on demand, payable to bearer or payable to bearer on demand?
The holder asks for it. For example, pay 10,000 rupees to bearer on demand. That means whoever is holding that paper can show up and ask for the 10,000 rupees to be paid right away, which is why it's restricted. It could circulate like cash.
Could you please give two examples for each after reading the statement for each and specify the differences?
Let me pull that cleanly. Sure. First statement, payable to bearer. Example 1, pay 10,000 rupees to bearer after 60 days. Example 2, pay 25,000 rupees to bearer on October 1st, 2026. Here, the holder gets paid, but only at that future time. The second statement, payable to bearer on demand. Example 1, pay 10,000 rupees to bearer on demand. Example 2, pay 25,000 rupees to bearer whenever demanded. Here, payment is immediate on presentation. So the difference
So
is
the first one has
bearer-
so the first one is having a date.
Right. So payable to bearer tells who gets paid, and on demand tells when it's payable immediately. And that immediate bearer form is what the law bars.
So bills of exchange always having a date, specified date. Is it so?
Checking? No, a bill of exchange doesn't always need a specific future date. It can be payable on demand or at a fixed or determinable future time. So, pay on demand is valid as long as it's not payable to bearer on demand, which is the prohibitive form.
So payable on demand is only allowed when it is a when it is order in nature.
Right, exactly. On demand is defined if it's payable to a named person or order, like pay to RAM or order on demand. What's not allowed is pay to bearer on demand, because that basically turns into something that behaves like cash. So demand is okay, just not with bearer.
So I'll read the differences between a promissory note and a bills of exchanges. A promissory note.
Sure, go ahead.
A promissory note is an instrument in writing, being a bank note, not being a bank note or a currency note, containing an unconditional undertaking signed by the maker to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. While a bills of exchange is an instrument in writing containing an unconditional order signed by the maker directing a certain person to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument.
One moment. Yeah, your reading is mostly right. The main difference is an undertaking versus an order. A promissory note is a promise by the maker to pay. A bill of exchange is an order by the draw directing someone else to pay. Also, a promissory note can't be made payable to bearer at all, and a bill can't be made payable to bearer on demand.
So, what is the difference between undertaking and an order?
Checking? An undertaking is a promise by the person himself. Basically, I will pay you. An order is a direction to someone else. Basically, you pay him. In a promissory note, the maker is directly promising to pay. In a bill of exchange, the drawer tells the drawee to pay the payee. So undertaking is I pay, order is you pay.
So, in a promissory note, there is a promise to pay money, while in a bills of exchange, there is an order for making payment.
Exactly. Promise in a promissory note, order in a bill. That's the core difference.
So, parties in case of promissory note is the promissory note. There are only two parties, namely the maker and the payee. The maker is the one who is promising to pay, and the payee is the one who is getting paid. And in case of bills of exchange, there are three parties which are asunder, which is the drawee, which is the drawer, the drawee, and the payee.
Checking again? Yes, that's correct. Promissory note has two parties, maker and payee. Bill of exchange has three, drawer, drawee, and payee. And small point, in a bill, once the drawee accepts, he becomes the acceptor.
So acceptance, a promissory note does not require any acceptance, as it is signed by the person who is liable to pay, while a bills of exchange needs acceptance from the drawee.
One moment. Yes, that's correct. A promissory note doesn't need acceptance because the maker is already promising to pay. a bill of exchange needs the drawee's acceptance to make him liable. Once he accepts, he becomes the acceptor.
So payable to bearer, a promissory note cannot be made payable to bearer. On the other hand, a bills of exchange can be drawn payable to bearer. However, it cannot be payable to bearer on demand.
Checking? Yes, exactly right. Promissory note, no bearer. Bill of exchange, bearer is okay, but not bearer on demand.
Could you give an example where a bills of exchange is drawn on payable to bearer with a real life example? You have to make such example to make me understand.
Right. Sure. Suppose trader A sells goods to wholesaler B on 60 days credit. A draws a bill on B saying 60 days after date, pay 50,000 rupees to bearer. B accepts it. That bill is payable to the holder after 60 days, not on demand, so it's valid in concept. If instead it said pay 50,000 rupees to bearer on demand, that would not be allowed.
Could you repeat that again?
Sure. Imagine trader A sells goods to B on 60 days credit. A draws a bill saying, pay to bearer 50,000 rupees after 60 days. B accepts it. Then whoever holds that bill after 60 days can claim payment. That's payable to bearer, but not on demand. So it doesn't violate that rule. If it said pay to bearer on demand, that would be the problem.
So what is the example for the other one when it's payable to bearer on demand?
Check in again. Right. Example of the not allowed one. Pay 50,000 rupees to bearer on demand, meaning whoever holds that paper can walk in and immediately demand 50,000 rupees. That's the kind of instrument that could circulate hand to hand like money. So that's why it's prohibited. The allowed version would be payable to bearer after 60 days, since it's
Give
not
a
immediate.
comprehensive example.
One moment. Sure. Let's take a full example of the not allowed type. Say A traders draws a bill on B wholesaler saying, pay 50,000 rupees to bearer on demand. Here, A is the drawer, B is the drawee, bearer is whoever holds it. Now, if A hands that paper to C, C can walk in and demand 50,000 rupees from B immediately. If C passes it to D, D can also demand immediately. That's basically like circulating a currency note.
Is
which
it
is
like
why
it doesn't have any specific time?
right, exactly.
Okay, so the previous one is having a specific time, while this one has no specific time.
Right, that's right. The allowed one had a clear future time, like after 60 days, so payment isn't immediate. The prohibited one has no waiting period, on demand, meaning whoever holds it can demand payment right away. And that's the key difference.
No specific time. Let me note it down somewhere.
Yeah, no rush. Take your time.
Has a specific time. Now my last questions regarding check. A check
Okay.
is a bill of exchange. A check is a bill of exchange drawn on specified banker and not expressed to be payable otherwise than on demand. And it includes the electronic image of a truncated check and check in the electronic form. By reading, I understood that it's a bills of exchange, but previously we have studied and we understood that bills of exchange cannot be payable to bearer on demand, but a check can be. I guess so. Am I correct?
A moment. Yes, checks are a special kind of bill of exchange. The law makes an exception for checks. A normal bill can't be payable to bearer on demand, but a check can be payable to bearer on demand because checks are drawn on a banker and are specifically permitted.
So a
That's
check,
why you'll
so a
see
check is a
paper-
bills of exchange drawn on a specified banker. When they say a specified banker, does it mean the bank on which the
checking. Yes. The specified banker just means the particular bank on which the check is drawn, like your specific branch or bank where the account is held. Our check is always drawn on a bank, unlike a normal bill, which can be drawn on any person. So for a check, the drawee has to be a bank.
so a check is a bills of exchange drawn on a specified banker and not expressed to be payable otherwise than on demand, and it includes electronic image of a truncated check and check in the electronic form. Could you explain the definition word by word?
Checking. Alright, word by word. A check is a bill of exchange. That means it's an order to pay, not a promise. Drawn on a specified banker means the order is always directed to a particular bank where the drawer has an account. Not expressed to be payable otherwise than on demand basically means a check is always payable on demand. You present it, the bank pays. It can't be like pay after 60 days. Includes the electronic image of a truncated
Then why
check.
they
Check.
use the word not and not express to be payable otherwise than on demand?
Checking. That's just legal language. Not expressed to be payable otherwise than on demand is a roundabout way of saying it must be payable only on demand. They use the negative phrasing to make it clear that no other timing is allowed. So, like no after 30 days or after 60 days. Just payable on demand, full stop.
Is the word
That's just-
otherwise is the main reason for the negative?
Checking? Yeah, exactly. The word otherwise is what triggers that negative phrasing. Payable otherwise than on demand means payable in any way other than on demand. And then they say not expressed to be, meaning it must not be written that way. So the net effect is a check must be only on demand. It's just dense legal wording.
So, and it includes. Now go on with the word to word explanation which you were explaining earlier. Proceed further.
Sure. Of course. Picking up includes the electronic image of a truncated check, means when the physical check is stopped and its scanned image is sent for clearing, the law treats that image as the check itself. Check in electronic form means a check created and signed digitally under the IT Act instead of on paper. So basically, the definition covers paper checks and modern electronic versions.
So when the physical check is scanned, is it made into a truncated check? Is it so?
Checking? Yes, it's exactly. When a physical check is scanned and instead of sending the paper forward, the bank sends the electronic image for clearing, that is truncation. The
So
physical check,
so when it's made into a truncated check, the physical check becomes invalid. Is it so?
checking? Not exactly. The physical check doesn't become invalid, it just isn't physically moved forward anymore. The bank keeps it as a record and the electronic image is used for clearing. So the check remains valid as a record, but the transaction is processed on the basis of the image.
What if the any other person uses that physical check to withdraw again? Is it possible?
Checking. No, that's not normal. Once a check is truncated and it's in. So the check is with the person all the while it's being transacted or whatever the phrase is. And once it's done, it's not like the physical check is gone or anything. It still remains with the person. Am I correct?
No, I mean, can a check can be issued with the same check? With this, first say, oh, I have a check which is in physical form. Can I withdraw again and again with the same check? If anyhow I get the physical check back from the bank.
Check in. No, one check leaf can only be used once. So once it's been paid, the check number is recorded and can't be presented again. A second try should be rejected as a duplicate or a fraud.
So is it checked by manually or is it checked by any sort of technology?
One sec. It can be both now. A check can be a traditional physical paper check where you write and sign by hand, or it can involve technology, like an electronic image of a truncated check or a check that's created and signed digitally as allowed by law.
So payable on demand means it should be payable whenever the holder chooses to present to the drawee. Here the drawee is a banker.
Checking? Yeah, that's right. For a check, payable on demand means whenever the holder presents it, the bank has to pay, assuming of course it's otherwise valid. The drawee is the bank on which the check is drawn.
So the expression banker includes any person acting. So the expression the banker includes any person acting as a banker and any post office saving bank. Section 3. What does it mean?
Checking? It means this act uses a broad definition of banker. So not just a formal bank, but anyone or any institution that's functioning as a bank, plus any post office savings bank, is treated as a banker for the purposes of this act. So if someone is running something that's functioning as a bank, it's treated as a bank under this act.
So any individual can also be termed as banker.
Checking? Yes, but only if that individual is actually carrying on banking functions. It's not just any ordinary person.
Is it possible
Lending
practically?
money. Checking.
I asked, is it practically possible for an individual to perform such activity?
Checking. Practically for a regular person today, no, not really. You need regulatory approval, like an RBI license, to carry on banking, and without that, you can't legally function as a bank. So the phrase is intentionally broad in law, but in real life, it's limited to properly authorized entities.
So explanation for the purpose of the section, the expressions, the check in the electronic form. The check in the electronic form means a check drawn in electronic form by using any computer resource and signed by signing in a secure system with a digital signature, with or without being biometric signature, and a symmetric crypto system or electronic signature, as the case may be. Is it stating about the truncated check, or is it something else?
Let me check. That's something else. A truncated check is a physical one that gets scanned and cleared as an electronic image. But what you've read is talking about a check in electronic form. So that's a check that's created digitally from the start using a secure computer system with a digital or electronic signature. So it's born digital, not scanned from paper.
So this is not a paper or physical check.
Let me double check. Correct. It starts digital from the beginning.
So a check in electronic form. It means a check drawn. Means a check drawn in electronic form by using computer resource, by using any computer resource, and signed in a secure system with a digital signature, with or without being biometric signature, and asymmetric crypto system. When they say a digital signature, how it's given?
One sec. A digital signature in this context isn't a pen name. It's a cryptographic signature. So think of it like this. You sign the electronic check using your private digital key through a secure system. That creates a unique code tied to that specific check.
Give
Others
example
verify-
how such things are performed.
Check in. Sure. Here's a simple example. Say A wants to issue an electronic check to B. A logs into their secure banking system, fills out the check details, and when it's time to sign, A uses a digital signature, like a certificate or a secured token, which applies A's private cryptographic key to that exact check. That creates a unique code tied to that document. Then the bank receiving it uses A's public key to verify that A signed it and that nothing was altered.
So it can be given in biometric as well.
Check in. It can involve biometrics too, like a fingerprint or iris scan, but that's usually just for confirming identity. The actual legal signature is still the secure digital cryptographically applied. Biometric is more like the way you prove it's you before the system applies that digital signature.
And they mentioned an asymmetric crypto system. What is the meaning?
Checking. That just means using a public and private key pair. One key signs, the other verifies. It's called asymmetric because the keys are different. Your private key creates the signature, and your public key lets others confirm it without exposing that private key.
So is it mean that the thing can be opened with two keys? One is having with a bank and another is with me.
Let me check. Almost. Not quite about opening. Your private key stays with you and is used to sign the check. Then the bank uses your public key to verify your signature. So it's not that both keys open something together, it's that one signs, the other checks.
And assigned in a secure system, and a digital signature with or without biometric signature, an asymmetric crypto system or electronic signature, as the case may be. Here, could you explain the last
that's
last
describing
phrase?
how the signature part
Explain the
works.
last line.
As the case may be, just means depending on what specific method is being used. So sometimes it's a digital signature with asymmetric crypto, sometimes another valid electronic signature method.
So, if I read it again, a check in the electronic form means a check drawn in electronic form by using any computer resource and signed in a secure system with a digital signature, with or without biometric signature, and asymmetric crypto system or electronic signature. Here they included electronic signature again. Why so?
Let me check. because digital signature is a specific kind of electronic signature, but electronic signature is the broader umbrella. So the law is saying use a digital signature with asymmetric crypto where applicable, or where the law permits another valid electronic signature method. It's belt and suspenders drafting to cover all legally recognized forms, not just the cryptographic one.
As we know, we have a digital currency now, and in almost every country. So my question is, uh, can due to some glitch, can a person withdraws a numerous and enormous wealth?
Check in. In theory, yes, a software glitch could cause incorrect balances or transactions, but in practice, regulated digital currency systems have ledger checks, limits, reconciliations, and fraud monitoring to catch and block that. You might see a display error, but actually pulling out unlimited funds is very unlikely, and any attempted exploitation would be treated as fraud.
So, as we know that digital money is operated by technologies, so yeah, is it possible that certain someone with high tech could transfer money without possessing any money just by just by hacking or certain something?
Checking. Attempted attacks are possible, but not in this simple way of just transferring money you don't have. Digital money systems rely on secure ledgers and authorization. So to move funds, the system has to validate that you have the balance and the right credentials. A hacker would have to break that underlying security, compromise accounts, or exploit a vulnerability, which is criminal and not trivial. So in exam terms, those systems aren't just technology, they're also about authorization, audit trails, and regulation.
For the purposes of this section, the expressions of asymmetric crypto system, computer resource, digital signature, electronic form, and electronic signature shall have the same meanings respectively assigned to them in the Information Technology Act 2000.
Checking. Yep, that line is basically a cross reference. It says all those technical terms carry the same meanings as defined in the Information Technology Act 2000. So, asymmetric crypto system, computer resource, digital signature, electronic form, electronic signature. Don't redefine them here. Just go by the IT Act definitions. Respectively, just matches each term to its corresponding
A
definition.
truncated check means a check which is truncated during a clearing cycle, either by clearing house or by the bank, whether paying or receiving payment immediately on generation of an electronic image. For transmission, substituting the further physical movement of the check in writing. Could you explain this in word to word?
Checking. Sure. A truncated check means a check that is a regular paper check in writing whose physical movement is stopped during the
No,
clearing
it
process.
starts like truncated check means a check which is truncated. When they say a truncated check is a truncated, what truncated means here?
Checking. Here, truncated just means cut short or stopped. So the physical movement of that paper check is cut short during clearing. Instead of sending the paper onward, the bank scans it and sends the electronic image instead.
So does it mean stop?
Yeah, stop in the sense of stopping the physical journey of the paper check. It doesn't cancel the check, it just halts the paper movement and continues with the electronic image.
So a truncated check is a check which is stopped which is a physical. When a physical check is stopped, it's a truncated check.
Exactly. A truncated check is a paper check whose physical movement is stopped, and then its electronic image is used from that point on.
For further process,
That process keeps going, but electronically. So the image is sent through the clearing system instead of the paper, so it can be processed and settled between banks.
so a truncated check means a check which is truncated, which is stopped during a clearing cycle, either by the clearing house or by the bank, whether paying or receiving the payment immediately on generation of an electronic image.
Right. That means the paper check's movement is stopped during clearing by the clearinghouse or a bank as soon as it's scanned.
For transmission or substituting the further physical movement on the check in writing.
Exactly. The electronic image is sent instead, and that replaces sending the physical paper check any further. So the clearance continues digitally.
So explanation for the purpose of this section: the expression clearinghouse means the clearinghouse managed by the RBI or clearinghouse recognized as the such by the RBI. Explanation to 3 is for the purpose of the section of this section. The expressions asymmetric crypto system. Asymmetric crypto system, computer source, digital signature, electronic form, and electronic signature shall have the meanings respectively assigned them in the IT Act 2000. Where is IT Act mentioned?
Checking. It's mentioned in explanation 3 of that section. So the NI Act is saying that for those technical terms, like digital signature or computer resource, use the meanings given in the IT Act 2000. So it doesn't redefine them here. It just points you to the IT Act.
So a combined reading section 5 and 6 tells us the bill of exchange is a negotiable instrument in writing containing an instruction to a third party to pay a stated sum of money at a designated future date on demand or on demand. Whereas a check is also bills of exchange, but it is drawn on a banker and payable on demand. The parties to check a drawee and pay. The drawer, the person who draws a check, makes the check, who is the debtor, and his liability is primarily and unconditional. And option 2 is the drawee, the specific bank on whom a check is drawn. The specific bank on whom the check is drawn. He makes the payment of the check. The specific bank on whom the check is drawn. He makes the payment of the check in case of check. Drawee is always a banker.
Right. In a check, the drawee is always a bank. The customer is the drawer. The bank is asked to pay.
So drawee in case of a need. When the bill or any endorsement. Drawee in case of need. When the bill or in any endorsement thereon the name of any person is given in addition to the drawee to be resorted in case in not need such person is called a drawee in case of need. Is it talking about when the drawee cannot pay or something like that. Am I audible?
Mm-hmm.
So,
Yes, you've got the idea. Drawee in case of need is basically a backup named in the bill. So if the original drawee doesn't accept or pay, the holder should approach the person named as the drawee in case of need. So it's like a designated fallback, and the bill isn't treated as dishonored until that person also refuses. So yes, it's for situations where the original drawee doesn't honor the bill.
so the P, the person named P, the person named in the instrument, the person who in whose favor the check is issued, or to whom the whose order the money is by the instrument directed to be paid is called the payee. The payee may be the drawer himself or a third party.
Right. That's correct. The payee is the one entitled to receive the money. That person can be a third party or even the drawer himself.
When we withdraw from a bank, not being mm, oh, not without going to the automated teller machine. Let's say, is there any way? Is there what are the other ways to be to withdraw without a self-paid check?
One moment. Yes. If you don't want to use an ATM or self-check, you can usually withdraw by using a bank withdrawal slip or form at the branch. In some cases, a bearer check if you authorize someone else, or through a banking correspondent or micro ATM service in some areas. So if the key is no ATM and no self-check, then the withdrawal slip at your branch is the straightforward option.
Why there are two options of self-paid check and withdraw slip as well? When they do the same thing.
Checking. Both can get you cash, but they're different in nature. A self-check is a negotiable instrument under law, while a withdrawal slip is just a bank form for account holders. Same outcome, different legal in nature.
Essential characteristics of a check. According to the definition of check under section 6, a check is a species of a bill of exchange. Thus, it should be fulfill all the essential characteristics of a bill of exchange, and it must be drawn on a specified banker, or it must be payable on demand.
That's right. A check is a type of bill of exchange, but it must